Joining me now on the show, very pleased to welcome back Martin Murenbeld, Chief Economist of Dundee Economics. Martin, appreciate you finding time for us this weekend. Let me just start with the question that seems to be dominating all the financial markets, and that is, you know, the classic will she, won't she? Will Janet Yellen, the Federal Reserve, raise rates? It looks like after some of the job data we got a week ago, the answer is no for June, but she came out again this past week and sort of hints it's not far away.
Yeah, no, she keeps saying that, if things develop as she expects, and they expect that they're very close to full employment. In other words, the unemployment rate can come down a little bit further. And if, indeed, inflation rates in the United States, consumer price inflation rates, move to 2% or a little bit higher, if all that happens, then she says we should probably raise rates. So you can see how much I'm putting in the hedge in there, right? And that's the way she's been talking pretty well all year. It is if this, then that, but we're not sure about if this. And
I look at some of the other numbers. Yeah, I think they have consistently, and it's what Stephen Polo said a year ago in January, it's been serially disappointing. The other thing on those unemployment numbers, though, that I have to mention every time is that they don't count anybody who's not been employed for 6 months. And at the same time they're dropping their unemployment, they got 95 million people permanently unemployed. Yeah. And that, to me, is the most frightening stat when it comes to social unrest and economic ramifications of that. But, it's interesting that, not many people are thinking she'll raise them in June. Excuse me, maybe they did 2 months or a month ago, but now we're pushing it out to July. But as you said, if things develop as they expect, well, they've been wrong a long time.
No, that's very true. We have been forecasting pretty well all year. And in fact, as of the hike in December of last year, that the next rate hike would be September. Now, that looked like a pretty good bet earlier in the year. It looked like a pretty thin bet. For a while there, because as I'm sure you know, the probabilities in terms of the Fed futures signals suggested that the probabilities for a rate hike in June or July, or July, had risen quite dramatically. So we thought, should we move our forecast towards July? I didn't think June would be a good time to hike because it would be a short week before the Brexit vote, and so they might feel awkward if they'd raise. Anyways, long story short, as you said, the employment numbers came out. They were very weak. It was a bit of a stunner, and it moved the whole complex of probabilities over towards September. So that's what we think.
It also gave us a hint, though, with why this is important. We're talking about it right off the top here because we see every time there's a move like this, the perception changes. We get a major move across various markets, and we've certainly seen a reaction when the thing went to, yes, she's going to raise rates maybe as soon as June, then, oh, no, now she's not going to. And then you see obviously the Canadian dollar makes a move, gold makes a move, stocks make a move. It's interesting to see so much pivot on what the Federal Reserve does.
Yeah, and then the other factor that starts to come into the equation is how is Brexit going to play out?
Yeah,
as you said in your opening remarks, yesterday we had a bit of a shock. We had that poll that came out that showed that Brexit was very much in the lead, and you saw bonds rally, long rates come down, flight to safety. The dollar goes up a little bit, and at the same time, gold goes up a little bit, which is something, by the way, that I expect to see happening over the next couple of weeks, that gold and the dollar will rise together, and I'm pretty confident gold is going to break $1,300 before we have a Brexit vote.
It's fascinating to see, of course, because markets anticipate movements, and we've been talking about the Brexit vote for a number of months, but our scenario looks like it's played out that I did mark on the opening comment is once confidence starts leaving government, then you get all of this kind of stuff, and there isn't confidence in our elites. And so I've been fascinating to watch the poll numbers continually rise in favor of leaving the EU. We'll see how it plays out, because that's a very fundamental change. All the elites are lining up on one side of that equation, and we'll still see how it plays out. But it's part of that broader scenario I'm talking about, that I think they're in trouble on that. And then the markets, as you say, Martin, there's going to be huge reaction there if we get closer to June 23rd when they vote, and it looks like that indeed is going to happen.
Yeah. Now, what can happen then is, you get a surge in the gold price, you get a bit of a surge in the Canadian dollar, you get a surge in bond yields, and then by June the 22nd, there's a lot of discounting going on, and there's a lot of potential Brexit votes that have been discounted. And then suppose it turns out that some of these polls have over projected the Brexit, and you have a no vote. And then, so this is the kind of thing that we're looking at here, that a lot of volatility, and I think it probably has started to affect the equity markets as well. We're actually fairly positive on equity markets, believe it or not. I mean, a lot of people have been talking about, the equity markets are high PEs and so on and so forth. But when we run our models where we look at the, interest rates, current level of interest rates and so forth, I don't know if people know this, but, the S&P pays out a dividend, that is, so that the index dividend is a higher rate of return than the 10-year bond. So that, to me, says, hey, that's not, as it stands on the face of it, an unattractive proposition. In Canada, it's slightly higher. Let's say it's pretty close. But, if you look at the typical household portfolio where you've got equities, bonds, and real estate, of those three, which ones would you like to buy? Mm-hmm. And if you don't like any of them, then I say, hey, put some gold in there as well, because I think gold is an excellent diversifier. And there are so many studies on this that it's beyond doubt that gold adds to a portfolio.
Martin, I've got to take a quick break here. I'll come back with the chief economist, Dundee Economics, Martin Murenbeld, but we'll go right to gold when we come back. But also, I hope you heard what he just said, a sort of a longer-term bullish view on stocks, which I agree with, because where else are you putting your money with interest rates like this? Well, maybe gold, maybe real estate, but that's the kind of choices. Money's got to flow somewhere. More with Martin Murenbeld across the chorus. Hey, coming up, my favorite story of the week. Actually, I should call it the coolest story of the week. If you like cool things, especially from the tech side, wait till you hear this one. Right now, though, Martin Murenbeld is with me. He's the chief economist, Dundee Economics. Martin, let me just start with this. If rates indeed go higher, is that good news for gold? I mean, it sort of will be bad news for the Canadian dollar, as an example. What about gold?
Yeah, that's a good question. The answer relies on what are the factors that would drive interest rates higher. We said that our forecast was that the Fed would raise in September, but that's not a slam dunk either. They may not raise, but let's assume that they raise. Then they will be relaying to the market that inflation rates have moved up. Okay. Now, with inflation rates moving up, and currently inflation rates are, let's say, something around 1.3%, so that means they're close to 2%. So inflation will have gone up like 70 basis points. Okay. The interest rates go up 25 basis points. So guess what? The real interest rate actually declines. And that is the key for gold. What is the real interest rate doing? Okay, so the Fed can raise interest rates, but if they remain behind the inflation rate, right? That is, as we used to say, they're still behind the curve or behind the ball, right? Then it actually is quite positive for gold.
Well, the other side is gold is looked at as a currency by many people. I forget, was it Stanley Druckenmiller was saying that a couple of weeks ago, that he sees that as his biggest currency position.
Yeah.
That plays a big part. And one of my themes is if confidence gets lost in the U.S. system, which I think it's about to with the election of either party, then you can see a movement that way based on, an attractiveness like who the heck knows what currency I want, ergo I want some gold.
Well, that's very true. We have, ever since we started analyzing gold back in the 80s, considered gold to be a currency. And we've always kind of looked at gold from the perspective of what is happening to interest rates, the dollar, and inflation, much less from the perspective of how much is produced, what is demand in China, and so forth. Obviously, things are important, but the critical aspect here is what is going on with the currency market. And you brought it up, so I just switch a little bit. We've all focused myopically on this lousy 25 basis point hike, which may or may not come. Right? In the scheme of things, it is relatively small of importance. What you've got after November is the potential of, and you brought it up, of a Trump presidency or a Clinton presidency. They're going to address what's happened, quotes unquote, to the middle class. I fully anticipate both will want to actually work their way towards some devaluation of the dollar, because an awful lot of economic studies indicate that the dollar is fundamentally overvalued, and you can see that in terms of all the trade that the U.S. has, non-oil trade that it has with countries around the world, and these deficits that the U.S. have continue to blow up. They're larger and larger as we go forward. And so the dollar is somewhat overvalued. And of course, this hurts directly the employment position in the United States. And it hurts wages in the United States because you're in constant competition with producers abroad. So I think that's what I'm looking at into next year, that the dollar is going to become weaker, and this is going to be a very positive thing for exporting firms out of the U.S. It's going to be positive for gold. It's going to be positive for import competing firms in the U.S.
I don't want to run out of time. We only got a couple minutes left, and I want to get, last year, I love this, you've done it all your career, but you give scenarios for gold pricing. Like you'll say, this is a 20%, this is 50%. Last year, you were just dead on with what gold was going to do. What are you looking out in your scenarios? What's the most highest probability as you look out going in the next, say, pick your time frame, but I'm saying, let's say the next year.
Okay, we have a 45% probability of gold finishing this year just slightly above 1,360 and averaging next year in the 1,400s. Okay. Then the alternative numbers are somewhat lower. They're in the mid-1,200s. Our baseline, when we put the probabilities all together, our baseline is 1,268 at year end, about 1,250 as an average for the year. Now, that doesn't sound very high, but understand that the gold prices averaged year to date only $1,212. So to average 1,250 for the year, we're looking at something in the 1,280s as an average for the second half of the year. That's the kind of number we're looking at, but there is a significant probability that we're going to average well above 1,400 next year, and we're going to close the year above 1,360.
Well, as always, it's absolutely fascinating to get a chance to chat with Martin Murenbeld. Martin, thank you for taking the time.
Thank you for having me on.
Martin Murenbeld is chief economist of Dundee Economics. There you go. We were talking earlier with Drew Zimmerman on the big fat idea. One of the things that's great is if you get sort of these stable markets, that's where selling puts continues to make you some money. So keep that one in mind, too. We, of course, have a chance to talk more about that